Accounts that have been verified as U.S. accounts will be subject to IRS reporting. But sharing information about these accounts without the account holder's permission would be a breach of local privacy laws in most countries. So, FFIs will first need to obtain privacy waivers from their U.S. clients before reporting can take place. However, sometimes it won't immediately be apparent whether an account is U.S. owned or not, in which case an FFI may need to seek additional evidence from the clients linked to those assets to establish whether or not they count as U.S. assets for FATCA purposes. And the affected clients have a time limit within which to provide any evidence an FFI has requested, either to verify or disprove their U.S. status. If a client fails to cooperate by refusing to grant the necessary privacy waivers, or by failing to provide evidence within the agreed timescale, or by failing to disclose assets fully in their annual tax returns to the IRS, then the participating FFI must treat their accounts as recalcitrant accounts and must withhold U.S. source payments from them, with those payments then being subject to a 30% withholding tax. Now, in theory, this agreement to participate in FATCA is optional rather than mandatory. An FFI could theoretically avoid FATCA rules altogether by ceasing to hold accounts for U.S. clients or to trade in U.S. securities. But the price of this non-participation is very significant because apart from any business strategy implications, any FFI that doesn't enter into FATCA agreement with the IRS and which isn't otherwise exempt from FATCA rules is classified as non-participating FFI. And U.S. source payments to non-participating FFIs are then subject to a 30% withholding tax, which is deducted and paid directly to the IRS. Effectively, FATCA functions on the assumption that all foreign financial institutions will, in fact, enter into an agreement with the IRS, since the costs of not complying with FATCA are likely to be simply too great.
Yes. Well, assuming that your organization has decided to participate, it will be undertaking a quite significant operational program to get ready for FATCA. And depending on who you are and what business or function you work in, your support might be required from across a wide range of required activity. The first and most pressing aspect of implementation is for an FFI to identify which of its existing clients are going to be affected by FATCA, which isn't a straightforward thing to do, since FATCA-affected relationships aren't confined to just people with U.S. passports and companies incorporated in the U.S. Now, apart from the identification of affected relationships, the FFI will need to adapt applications, systems, and work processes to facilitate a wide range of FATCA-required activities. And just stop for a moment and consider, from what we've learned so far, the sheer range of issues to be addressed. The ongoing monitoring of existing accounts and their ownership, transaction histories, and average balances in line with FATCA rules. Obtaining information from potentially affected clients where this is needed. Identifying during account opening all new accounts that may be affected by FATCA. Obtaining privacy waivers from all affected account holders so that account details can be reported to the IRS without breaching local privacy laws. Flagging recalcitrant accounts, identifying and withholding any U.S. source income to these accounts, and calculating and deducting any withholding tax payable to the IRS on these accounts. And of course, developing appropriate trigger mechanisms and reporting systems to ensure that information on U.S. accounts is reported in compliance with their FATCA agreement.